Ever found yourself pondering how the stock market works? Well, let's dive in and unravel this mystery together. Imagine a bustling farmer's market. You've got sellers hawking their fresh produce, and buyers with their reusable bags, ready to fill them up with the best that the season has to offer. Now replace those fruits and veggies with shares of companies. That's your basic idea of a stock market. Like the farmer's market, the stock market is a meeting place. But instead of trading apples for dollars, buyers and sellers trade shares of companies. These shares represent a slice of ownership in a company. When you buy a share, you're essentially buying a piece of that company. You become a shareholder, with the hope that the company will grow and prosper, increasing the value of your slice of the pie. So, in essence, the stock market is like a supercharged farmer's market trading in company shares instead of tomatoes. Now, you might be asking yourself, what are these so-called shares? Well, let's break it down. You can think of shares as slices of a delicious pie, but instead of a mouth-watering dessert, this pie represents a company. Each slice or share represents a piece of ownership in that company. So, let's say we have a company pie with 100 slices. If you buy one slice, you now own 1% of that company. You're a 1% pie owner, if you will. And here's where it gets interesting. As the company grows and becomes more valuable, so does your slice of the pie. If the company doubles in value, your 1% slice now represents a much larger chunk of cash. So, when you buy a share, you're essentially buying a piece of the company's pie. And who doesn't love a slice of pie that can grow bigger over time? But how do these slices of pie change in value? Why does one day a slice cost $5 and the next day $6? Well, let's delve into that, shall we? Think of it this way. Imagine you're at a pie-eating contest and the pie is oh so delicious. The more people who want a slice of that pie, the more valuable each slice becomes. This is because the quantity of pie is limited and everyone's trying to grab a piece. This, my friends, is what we call supply and demand. Now apply this to stocks. Each company has a finite number of stocks or slices of pie. If more people want a slice of a specific company's pie, the demand goes up. And with increased demand, the price of that slice or stock increases. Conversely, if fewer people want it, the demand and consequently the price goes down. So the price of a stock or our slice of pie fluctuates based on how many people want a piece of it. There you have it, the whirling world of stock prices. You may be wondering, why would I want to buy these slices of company pie? Well, let me paint a picture for you. Think about a company like Amazon. 2 decades ago, it was a fledgling online bookstore. If you had bought some shares then, well, today you'd probably be reading this script from your private island. Investing in the stock market is a bit like planting a seed and watching it grow. It's about having a stake in a company's future and reaping the rewards as it blossoms. Sure, not every seed becomes a towering tree, but when they do, the financial gains can be substantial. The stock market allows us, the everyday folks, to buy a piece of the corporate world. And if the company or companies we invest in do well, we get a slice of those profits. It's not just about making money, it's about participating in the growth of businesses we believe in. So, investing in the stock market could mean a bigger wallet if your chosen company or companies do well. But like any marketplace, the stock market isn't without its risks. Now, just as you wouldn't buy a car without checking under the hood, you shouldn't dive into the stock market without doing your homework. The biggest risk, of course, is financial loss. You might buy a stock expecting it to rise, but instead it plummets. Ouch! That's why it's crucial to research and make informed decisions. You wouldn't buy a car just because it's pretty, right? You'd want to know about the engine, the mileage, the previous owners. Similarly, understanding a company's financial health, the industry it's in, and its future prospects is vital. But here's the thing. As intimidating as these risks may sound, they're balanced out by potential rewards. Imagine buying a stock at a low price and watching it soar. That's the thrill of the stock market. Remember, the stock market is like any marketplace. It's all about making smart choices with your money.